Mr. Willett, another quarter of quarterly earnings calls is in the rearview mirror. How are you feeling about Q2 2025?
It's one that's in the books. You know, you and I have been doing a lot of individual client conversations over the last couple of weeks. So I feel like
Yeah,
we talk to each other every day now.
it's pretty close. Like I tried not to bug you over the weekend, but we were emailing back and forth over what we are going to talk about for this call. So, always appreciate you doing this with me. I always appreciate your insight and letting me stand on your shoulders for all of this. So, but let's start with what was kind of your general takeaway for the quarter?
If I had one thing to say here is the storylines were pretty diverse this time versus a lot of times in the series of REIT earnings calls. You go from one company to another and they tell the same story.
Yes, it's
Versus,
rinse and repeat a lot.
yeah, this time I felt like there was more diversity in what they talked about, and it was maybe less about what was happening in the market overall than it was just you're telling your individual company stories.
I feel you on that. I also think that the analyst question, because I get a lot by just listening to what the analysts are asking about. I felt that their questions were a little more diverse, with some major exceptions we'll talk about. Um, but I do wonder if that was a function of the stated commentary being kind of more bespoke this time than common themes. But I think we should point out the fact that for the most part, performance was strong with the REITs.
Performances were strong, and to the point that, well, I think everybody at least hit their numbers, if not exceeded
I think you're right on that.
their stated numbers. And you had half the REITs that actually increased guidance
Yeah.
for the remainder of the year. So, I mean, these were very good
Well,
results.
and the ones that increased guidance, I did notice that the guidance increase was almost always a function of two things. It wasn't just one thing. And we'll talk more in depth on both. But number one was improved or better than expected rent performance, um, entirely driven by
I'm going to
renewals.
jump in there.
Please.
It was not better than expected rent performance. It was better than expected occupancy
Okay, revenue
performance.
Very good point. Thank you.
It was revenue, but it was occupancy driven rather than rent growth
You you
driven.
you are you are 100% right on that. But where I was going to go with that is the blended rents performance that we had. I mean, they had a couple that said their blended rent performance was better than expected, but the key word in that is blended. You know, that blended rent performance was entirely driven from the renewal side of the equation. And that renewal side of the equation really was driving the occupancy, which I think is one of the big themes. They're clearly still very much heads on beds. Occupancy is king. That's how we're getting through this supply wave.
Yeah, absolutely. So, um, and I have to say, I was not super surprised to hear that, particularly if you've been following the month to month
Yeah.
performance numbers for the market overall. The other part of this equation, though, maybe a little bit more surprising, is everybody seemed to be doing better on expense control than they expected to be.
Agreed. And again, because again, anyone who upped their guidance, and like I said, about half of them upped guidance for the full year. They had an up on the revenue and on the expense side, and I'm sure you caught it. The expense side performance tended to come from two major categories. The big one I mean, the first one I think is insurance. We've seen those premiums being mitigating and actually, I mean, I think I'm right in this. I heard a couple of them say that they're actually coming down. Like not just that the increase wasn't as much.
Yeah, and
Actually
it's not
coming.
just the REITs. As we talk to individual clients that we are constantly in conversation with, I'm hearing over and over again that insurance costs are not just smaller increases than what you were anticipating. They're actually moving into reverse.
Yeah, the other big category that was universally commented on was all the efforts they put into mitigating real estate taxes, which I might be a little bit of a pessimist, but to me, that is a function of how many of the properties valuation has actually come down, and therefore what they were paying in real estate taxes is less than what they budgeted.
Yeah, you're right. I mean, that's a good news, bad news situation. You
Yeah.
are paying lower taxes, but that's because the value of your asset has dropped.
Well, I mean, it's as a former property manager and regional manager, the way you get your bonus, I'm not saying they're doing this, the way you get your bonus is you, as much as reasonably possible, underestimate revenue and overestimate expenses. And you're going to hit your NOI number and probably get that bonus every single time. Now, doing that reasonably is the art form. But yeah, when we're talking about about the third call when I was hearing, the mitigation of real estate taxes, like, okay, this is just valuations coming down. By the way, this was also something that I don't think we talked about. I was also hearing on the single family calls. The single family calls were also seeing the savings within the real estate tax burden as well. So we've talked about those broad performances. I think it's important to start off with overall, it seemed to be a good quarter for them. Let's go into the overall market though. Overall, what was your sense of how everyone is feeling about the marketplace in general? And then we can kind of go into what were the darling and the not darling markets of from a performance perspective.
Certainly, you've mentioned everybody's playing that heads on beds strategy, so they're feeling good about the demand numbers that they're experiencing, and to kind of already segueing into that individual markets, man, they loved talking about the gateway coastal markets this time. And so there was just lots and lots of conversation about those markets for the companies that have exposure to those markets in their portfolios. That's not everybody.
Sure.
But certainly the big mover with momentum is the Bay Area, both San Francisco and San Jose. I think everybody's still pleased with what they're seeing in New York, New Jersey, in Boston, some good news in Seattle, and usually in that gateway category, even though it's not coastal, you count Chicago in that group. So those were all good news. The analysts love talking about those markets, so you got a bunch of follow-up questions.
Yes.
And then we had the two more interesting ones to explore.
Yeah, I mean, there were two markets that I would say, if I were to use the word obsessed over, the analysts obsessed over. And those two were Washington, D.C. and Los Angeles for very different reasons.
Right.
I got the feeling that the analysts are waiting for the bottom to fall out of D.C. Just the commentary there is so perfect that DC is going to crash because of the political environment and Doge and all the things, and they're waiting for it and trying to get ahead of it for good reasons.
And I'll point out the numbers that the REITs reported for DC all were very
good,
healthy.
Yeah.
But you did have a couple of REITs that acknowledged that it was a little bit softer in the last 30 to 60 days compared to what you had been seeing. And boy, did the analysts pounce on that.
Yes, they did. But it's funny because I think I felt that way about performance in general. It seems to be softer than everyone is expecting the last 30 to 60 days. And I would say that even with the market updates we've been doing sitting with our partners, it has felt to me that seasonality is starting to flatten instead of seeing the big swing we did. And I don't know if that's a hangover from COVID or what, but I feel that more than just in DC, but you're right. The analysts were all over it for DC.
They were all over it for DC. And then LA was an interesting discussion because every company that had a meaningful block of product in LA seemed to have a different experience.
Yes.
I mean, there were no There were no shared takeaways for the LA market.
and to the extremes. Like for one group, it was their worst performing market. For another group, it was their top performing market. And I think that just goes to show how localized real estate and real estate performance really is. You know, I mean, I'm from LA. Like I grew up in that area of the country. You know, being in Los Angeles is incredibly different than being in Los Angeles County. You know, I mean, the not only just the demographics and everything that's going on and the economics that's going on, but just the regulation that's going on within the city of LA versus like I grew up in Claremont, California, which is the furthest east you can go and still be in LA County, but it was LA County, which is very, very different.
And let me flip it and address the Sunbelt markets briefly. And so everybody was happy with the demand story in the Sunbelt,
Yep.
but there were lots of completions. And so struggling a little bit on the overall momentum. So it's not like it was bad news on those markets, but it was just what you expected to hear. So you didn't really get many follow-up questions
Well,
there.
and it's interesting. One follow-up question that did come up out of those when these REITs are talking about, hey, this is this fantastic performance from the gateways, and oh yeah, the Sun Belt is here too and performed like we expected. Analysts were starting to question should, maybe not should, is your investment thesis that we want to move from some of these gateway markets into what they're going to call expansion markets, but every one of these REITs expansion markets is pretty much the Sun
Right.
Belt. You know, the confidence level of the REITs to go into the Sun Belt was super high. I didn't sense any questioning of whether they would continue doing that or not.
Yeah, you're right. I mean, you did get the question of does current performance change your strategy at all? And the answer clearly from every single REIT was no.
Yeah. Yeah. Very high degree of confidence in the investment strategy. Which to that point, it was interesting to see this quarter some of the moves the REITs are making to actually change their investment portfolio. You know, Camden had dispositions here in Texas to free up cash to be able to go into some of their expansion markets. So it was interesting to see, again, REITs kind of flexing their muscle, saying, okay, we've got a much lower cost of capital that we can be able to go into some of these areas we want to be and be advantageous buyers in these places. I think you're going to start seeing that.
Yeah, I mean they were very clear in that they're playing the long game. They're not playing here's the results for the next few months or even the next year.
Yeah, I mean, like again, I'm talking to Camden. You know, I think they disposed 3 Dallas assets and 1 Houston asset, all of whose lifespan was 30 years plus at that point. So it's not like they're abandoning markets. They're just turning capital on them. Okay, so since we're talking about supply and we're talking about that level, let's talk about the way the REITs were kind of talking about the supply in their markets. Is this something that they were still really focused on? Did you feel like they've been backing away from that? Are they waving their magic wand and immune? Like, what was your kind of take?
Every single one told the story of how future supply will be coming way down from where it has been, which is true.
Yeah.
But at the same time, I think maybe a story that in some cases they're overselling because you can have supply come down from recent levels, but that just means it's returning to historically normal levels, which I think is true in some cases. But you heard this over and over and over again.
Well, you recently did an analysis for these market updates where you were showing kind of major markets that were going from, okay, peak levels of supply, and were they going down to, you know, below average? And I think you used, if I remember correctly, 2015 through 2019 average deliveries. Were they going to below average, at average, or above average? And I'm picturing the map in my head and where all these guys are at. I think all of them were coming back to normalcy, not dramatically down, except I think maybe Southern California.
There were certainly the ones that you think of as the super supply markets were more toward just going back to normal than it was really coming down from past levels. But there were some coastal markets where the cutback was more extreme. And then, to me, kind of interesting as we looked at those, the Carolinas seem like they're going to settle at a level that's maybe a little bit below the past norm. Interestingly, there was virtually no discussion of the Carolinas in these calls, even though you do have
You're right. I hadn't thought about that.
some REITs do have some fairly significant product in the Carolinas and Tennessee.
I'm racking my brain. I'm not sure there was a whole lot of discussion on the Southeast at all.
Yeah, but
Yeah.
it kind of got ignored, reflecting the fascination with coastal gateways that
Yeah.
they, they've loved that story for decades, and the fact that you got a little bit of momentum there, they're all about it.
Yeah, it's the other thing that slipped by most folks, and there wasn't a whole lot of conversation around, but you pointed it out, and I think it's really interesting. Was a couple of the REITs are actually talking, not even talking, they're actually doing renovation programs in this environment, which you wouldn't necessarily expect. Um, Relatively small for their size, but still an interesting thought.
Yeah, that really jumped out at me, that a couple of REITs um, seem to, or are all in on this strategy of upgrading the existing product base at a time when the market in general is not doing
Right.
that. If I'm recalling the numbers correctly, I think that Camden said that they were going to upgrade 3,000 units this year, and MAA said they were going to upgrade, I think it was 6,000 units. I
Yep.
mean, that's a pretty significant commitment to that strategy.
Well, and the rent numbers they were talking about was $95 and $150 respectively, and I think I flip flopped those two, so it'd be Camden at 150 and MA at 95. Which, when I think about it from a return on investment perspective, I stop and think a little bit like, well, is that really enough to have the return on investment that you'd really be putting in? But as we were discussing earlier, it's also kind of that thought process of, okay, we're, we're in an advantaged position from a capital perspective. We're going to be first movers in. There's going to be distressed properties that are out there that we're going to be able to step in on. Do we have the muscle memory and the team in place to be able to act and take advantage of that? And I think there might be a little bit of that going on, of making sure let's keep these guys and gals active. Let's keep and make sure that we have that team ready to go when the right opportunity presents itself. Because I got the impression that they all think that opportunity is coming up in the relatively near future.
I think this is a storyline to keep a watch on. That this is not the last time we're going to discuss this.
Yeah. Okay. So another storyline to keep an eye on that I know, you and I both spend a lot of time thinking about is the renter health on this. And you picked up on a through line with renter health on these commentaries that overall it appears that the financial health of the renter for this demographic of type of property is strong and improving.
Yeah, and I'll underline that the people who rent and REIT properties are not necessarily representative of the renter base
Right.
in total. But certainly you've seen that income growth over the last couple of years has exceeded rent increases. So that puts these renters within this group in good position. And the companies that did specifically talk about rent to income ratios talked about low numbers that were trending downward. So that does put them in a favorable position over the next couple of years. Of they've got renters who will actually be able to afford some meaningful rent increases.
Well, and so you say afford rent increases. The other way they talked about renter health was really around fraud and bad debt, which the impression I got from most of them, there was an outlier in this conversation that I'm not going to call out, but there was one that definitely was not experiencing the same as the others, was that it feels like through technology, particularly screening, identity verification, they feel they've made meaningful progress on preventing fraud and collecting down the road. And I think that again, they called out the screening, and I think they also, at least one of them, called out the improved processes to actually move through the eviction
Right,
process in
right.
most areas.
Um, yes, so that was generally good news with the caveat that you do have um, certain locations where regulation or what was specifically talked about here was eviction court backlogs that you couldn't really get the rent roll completely cleaned up.
Yeah. Um, it's so a couple things that I well, one interesting observation, then one of the things that I didn't hear anybody talk about that I'd love to get your take on. Interesting observation was it's almost like the multifamily REITs are learning from the single family REITs, and the single family REITs are learning from the multifamily REITs. And let me give you specifics. In the multifamily REITs, centralization and specialization still was a conversation throughout, which, if you understand the way single family rentals on the REIT scale work, everything they do is centralized. That is their entire business model. So I kind of laugh. I'm sure the single family REITs are just laughing, going, "You're just doing this now." Um, the commonality I heard on all the single family REITs that I literally was like, "You're just doing this now." Lease expiration management. What I'm like,
Right,
really?
right. And I'll point out these historically these have been viewed as such different products that I don't think it really occurred to people to take a common approach. And there are only a handful of companies that do both to any meaningful degree.
Oh, I'd have a hard time really counting them out. You're right. I mean, there's, and even those that do have different arms doing it, they're different arms that don't, at least as far as I know, have a whole lot of talking and crossover. Um, but yeah, that was an interesting one that I was literally like, I'm like, oh, this is just a crossover between these two, types of operators. The other thing, and we can kind of maybe not end on this, we'll pick something a little nicer to end on. But one of the things that also surprised me, I may have missed it. I don't remember talk on tariffs or more specifically immigration on any of the calls.
I'm going to agree with that statement. And even to the degree that you talked about um, coastal gateway markets. And these are markets that historically you've been dependent on international immigration to fuel population growth in these markets. But it really didn't come up at all, which is very different than the one on one conversations we've had with clients
You,
over the past few weeks. That these topics get talked about a lot, and particularly immigration gets talked about. And boy, I don't think that was even mentioned on a single REIT call.
yeah, I mean, I think we were about halfway through the market updates we did for individual partners when I really started listening. Because if you guys don't know, there's one day where I think 5 REITs reported on the same day. It was just hour after hour after hour on a Thursday. Um, so we'd had some of these conversations. So I was expecting, much like our conversations we had, immigration didn't come up until we asked a question. But as soon as we asked a question, we probably had 20 to 25 minutes of conversation around the direct impact that immigration and immigration enforcement was having on properties of various different types, whether it was service providers being able to show up, whether it was, broken leases, all these types of things. I was surprised an analyst didn't ask the question, because I do think that maybe there's an air of caution that, well, we don't want to talk about this, but we will if someone asks us. So that was kind of interesting. So what overall, what was your takeaway, like, to wrap this whole thing up in a bow? How are you feeling about the REIT performance in the REIT calls for Q2 2025?
So again, it was solid performances, and they seem very confident moving ahead, and fewer uses of the word uncertainty than we had been hearing.
Yeah, I agree. Definitely more certain. So we appreciate you guys taking a listen. If you have any questions, want to ping us, let us know. We'll obviously be back again next quarter doing the same thing. Greg, as always, I appreciate you coming in.
Thank you, Andrew.